Are there some consumer cyclicals that could be offering interesting opportunities in this environment? Well, I've been watching Thor Industries lately and it's starting to get a little bit interesting. And so that's what I want to cover in this video. And so, guys, as you smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, Thor Industries is a very interesting stock. During the pandemic, a lot of people could not travel, and so what ended up happening is that the RV industry really took off in North America, and you can see that the share price followed. But what I was looking for here was that as the industry was starting to get red hot, I knew that, because it's a consumer cyclical industry, that eventually the demand would come off and all of these massive gains that the stock would have made would reverse and go much lower. And so, what I was hoping for was, prices in the, sub $80 per share area, even lower if I could potentially get it. And we're starting to get around into that area. And so I wanted to just take a look at what's happening with the company, what is their long-term guidance, et cetera, et cetera. And so that's what I'm going to cover next. Now, for those of you who have been watching this channel for a while, you guys know that I'm an RV nut. I really like the Class A, the motorized ones, but they're also the most expensive ones, but they're nice. Our Thor is the number one manufacturer of RVs. I wouldn't say that they're the best. If you ever go to an RV show, I've gone to way too many RV shows that I would like to admit, but if you ever go to them, if you ever see a Forest River brand or a Grand Design brand, those tend to be the better quality builds, but they're more expensive. Now, Forest River's owned by Berkshire Hathaway. I think Grand Design is owned by Thor at this point. And so just to give you an idea of what's happening, this is the RV Industry Association. So this is kind of what you want to follow if you're following the RV industry as a whole. Notice that all towable RVs are down 66.8% as of the January 2023 report. All motorhomes as well, like as a whole, are down 10.7%. So total RV shipments are down 61%. And so needless to say, this is a very cyclical industry and it's coming off the top at the moment. Now, because it's a cyclical industry, the question is the industry gone forever now that demand has fallen so much? I don't think so, Thor does talk about like the interest in the RV lifestyle. I do believe that, with work from home and just like remote work in general, I think especially among the young consumers, which are typically not consumers of this in this space, I think that interest is going to increase. And Thor is seeing it, so they're saying that the interest in the RV lifestyle continues to exceed pre-pandemic levels. Now, I say that that's just me logging into everyone's site every day because I'm a crazy RV person, but there might be other crazy psychos like myself. But notice that the utilization remains really high, so that's really good. And there is a bit of a stickiness in the lifestyle, and so let's see how this plays out. Generally, the RV lifestyle has been sort of like nomads and like older people, but I think that it's becoming more and more mainstream as time goes on. But I might just be wishfully thinking with that last point. Now, here's the thing. This article came out just recently in Barron's, and let's take a step back. It was a known issue that the RV industry went through a huge bubble during the pandemic, and we expected a slowdown in 2023. But the real issue is that I think management over at Thor underestimated how sharp the slowdown would be, mostly because it was very difficult to forecast how quickly the Fed would raise rates. And so I don't blame management for this. And so management actually had to take down their fiscal year 2023 guidance with this release. And you can see it happen here, where the company says that it now anticipates revenue to come down to around 10.5 to 11.5 billion. So 11 billion down from essentially 12 billion, which is what they were forecasting previously. So not a material decline, but, significant enough, I would say. I guess that would be considered material, but not like 50% or more is what I'm trying to get at there. And notice that inventory levels at dealers are somewhat elevated in this rate environment, which is very funny because, during 21 and 2022, I would drive by RV dealership lots and I would just see the lots completely empty. Yes, I know that I'm the only crazy person who's driving along looking at inventories at RV lots, but, we did see just zero inventory, and now you're actually seeing lots full and they're starting to discount just to move the product. And so, it's very interesting how the industry swung from one extreme to the other. And so because of that, Thor's backlog has fallen significantly. But one thing that's interesting is notice their diversification strategy is kind of working, right? Because, the RV backlog in the European market has remained elevated from last year. So the same level. In fact, went up a little bit. But of course, the North American towables and the North American motorized has fallen significantly. Of course, the towables has really fallen off a cliff down, that looks like 90%. And so this is from their latest quarterly release. You can see that the slowdown is actually accelerating because, at least in the North American towables, because you can see that it's down, sales are down 60%, and year to date they're down 50%. So this is getting worse for them. And I do believe that as time goes on, this is going to get more and more reflected into the share price, especially if the Fed continues to raise interest rates, because nobody's buying an RV or financing the purchase of an RV, which I think most of them are, when you have high interest rates like we do right now. And so I think this gets worse for them before it gets better. And the other thing is that, because costs are going up for them as well, because, inflation is running harder than we would expect it, they're having higher manufacturing overhead costs as a percentage of sales, which is reducing their gross profit margins. So notice that it's down to 6.4% from 19 last year, and year to date it's down to 11.6% from 18.6% last year. And they're increasing their sales discounts just to move product that's already manufactured. So, challenging environment to say the least. On the motorized side, you're seeing the same thing, but it's a little bit of a stickier industry of business. These are, higher priced homes. They deal with a higher income clientele, I would say. And so, the net sales are down 25%, but on a year-to-date basis, they're only down 2%. But, I would say that I would stick closer to this for forecasting out fiscal year results than I would with that. And so once again, just the decreases because of the unit shipments. There's just a lot of inventory at the dealers right now. And of course, there's increased overhead as a percentage of the sales. And notice that they're seeing higher warranty costs in this environment. So that's very interesting for the the motorized. But once again, same story. You're just going to see a slowdown across the board with the North American business. In Europe, things seem a little bit better. So, sales are down 10.6%, which is better than what the first quarter was, because year to date they're down 15%. So they just had a brutal first quarter. So things have gotten a little bit better or less worse. So that's really good. They seem to be constrained not by a weakening consumer so much as more something along like the supply chain constraints. But of course, you're going to have a weakening consumer in Europe as well. And so it's interesting that they were able to increase the net selling price, which increased their gross profit margin. I don't expect that to sustain, but we'll see how this plays out. Notice that in the quarter, their gross profit margin went up to 14.1% from 12.5% in the previous year, and year to date it's up to 13.9%. And so, the direction of the gross profit margin is upwards. And so very interesting. And, it speaks to the diversification strategy that they've been employing by getting into the European market, which I really like. And so what does their outlook look like? Well, they expect the near-term demand to continue to deteriorate. They wrote it nicely, but, if we're increasing rates, it's going to continue to deteriorate. And so, their revised guidance anticipates higher interest rates, elevated prices, so higher inflation, and full North American dealer inventory. So that will result in slower production pull through for the balance of the year. And so, what they did was, they reduced their net sales guidance by $1 billion. They reduced their gross profit margins, and they reduced their earnings per share range. But what I really like is notice how they put the previous guidance amounts here. Some companies will revise their outlooks like Thor did here, but they're not going to post the previous amounts. And I think this is a small item, but it really speaks to the quality of the management to not shy away from reducing guidance. And I really like that they do that. It's these little things, but they matter a lot, especially to people who look at these companies like owners. And, when I buy the shares of this company, the management become my partners. And so I want them to speak to me like a partner would speak to me. And so I really like this. So overall, things are down today, and they're probably going to be down tomorrow. But eventually, this downturn will subside, and Thor will continue to provide the U.S. consumer, the North American consumer, because you got to include Canada in there, with what they need or require from the RV manufacturing base. And so, I think that the company is right to have a 5-year performance projection. I don't actually think that they hit this $20 billion net sales guidance for 2027. I also don't think that they hit the 17% gross profit margin. Now, I'm not saying that they won't hit it, but what I'm saying is I'm not going to forecast this, but it's nice to see that management is holding to these projections. Now, this was from their investor day. They might bring these down, so we'll see how this plays out in their 2023 investor day, whether they hold to this or not. I think they do hold to this, and they're just going to work really hard to get to it. But how am I forecasting this out? Now, you guys might be modeling this differently, so I want to hear what you guys are thinking, or if I made any mistakes, or if I'm not thinking about something properly. But management is guiding to $20 billion in sales by 2027. I'm saying that can sales just get to 14 billion? Not that much higher. And really what 14 billion represents is, I expect, the North American towables to go backwards by 50% this year, motorized down by 25%, the European market down by 15%. So overall, I expect revenues to be under what they're forecasting. They're forecasting around 11 billion. I'm forecasting around 10.5. And then I expect, 8% growth thereafter until 2027. Even that, 7.5 to 8% growth might seem a little bit high. And so I'll reassess this as time goes on, but 14 billion in net sales growth is much lower than the 20 billion that they're forecasting for. Also, in terms of the gross profit margin, I don't see how the gross profit margin goes to 17%, but they might have better ideas than I do. Note that in 2022 they had gross profit margins of 21%. I'm forecasting up to 15%, on average 14%. So the question is, by 2027, can they get up to around 15% of a gross profit margin and miss their sales growth goals from 20 to 14? If they do that, it still seems like a value, at least in my opinion. This is not investment advice. It never is. And I'm not going to give you guys the share price valuation for it. But what I will tell you guys is that the Thor model has been added to the tracker that I use to follow all the securities. I have made an initial purchase into Thor using cash secured puts to really lower my entry point into the name. And we'll see if the share price comes down further so I can add to it. But you can see this is what the tracker looks like. You'll see the company name, and then you can click into the model that builds up to the intrinsic value calculation, and then the intrinsic value is compared to the current share price to give you a share price as a percentage of the intrinsic value. And so how do you get access to this tracker? Well, you can get access to the tracker and all the research that I have for this low amount of just $5 a month. I think this is the best value on YouTube, because largely it's just to show you guys how I build these models out. And I always welcome feedbacks. Sometimes there'll be Patreons who will say, hey, why are you doing this? Because I'm seeing this. And then sometimes that'll encourage me to actually rethink the way I'm thinking about it and change the assumption. And so we're all learning from this. And so I think this is a very good opportunity if you want to become a better financial statement modeler and really start investing like an owner. And speaking of investing like an owner, I actually recently put out a video where I talked about how I'm thinking about doubling or tripling down into Alibaba using sort of like options type opportunities. And so if you've missed that video, you can actually get into it right here.